Before we begin, please note that I am not a financial advisor, and this video is for educational and entertainment purposes only. The information presented here is not intended as financial, investment, tax, or legal advice. Investing involves risk, including the potential loss of principal. Always do your own research and consider consulting with a qualified professional before making any investment decisions. What if I told you that over the past 20 years, more than 93% of professional money managers, the so-called experts you pay a fortune to manage your 401k or IRA, failed to beat the market? Let that sink in. 93%. These are the sharpest minds from the best schools, with access to unimaginable resources, and almost all of them underperformed a simple, automated, boring investment strategy that anyone can use. This isn't just a statistic. It's the quiet scandal at the heart of the investment world, a multi-trillion-dollar industry built on a promise it consistently fails to keep. And the chances are you are paying for that failure. You're paying for it in fees that silently eat away at your retirement savings, year after year, costing you tens, if not hundreds of thousands of dollars over your lifetime. This is the great unspoken truth of Wall Street, and understanding it is the single most important step you can take towards securing your financial future. That's what this is all about. We are going to pull back the curtain on the biggest debate in investing. This is the financial heavyweight championship of the world. In one corner, weighing in with high fees and the promise of genius, we have actively managed funds. And in the other corner, the quiet, disciplined, and undisputed champion of long-term returns, the index fund. By the time we're done, you won't just know the difference between these two. You will understand on a deep, intuitive level why one strategy has created more everyday millionaires than any other in history, while the other has made Wall Street rich at the expense of Main Street. You will learn how to spot the hidden fees designed to drain your accounts, how to analyze your own portfolio, and how to build a simple, powerful, and low-cost investment plan that puts your money to work for you, not for some fund manager's bonus. This is the knowledge that separates the amateur investor from the one who builds lasting, generational wealth. So let's step into the ring and meet our first contender, the actively managed fund. The name itself sounds impressive, doesn't it? Active. It implies action, intelligence, a human hand on the wheel. And that's exactly the sales pitch. An actively managed fund is a pool of money collected from many investors, which is then managed by a professional fund manager or a team of analysts. Their job, their one and only mission, is to beat the market. They don't want to just match the performance of the S&P 500. They want to crush it. They are the celebrity chefs of the financial world. You're not just buying the raw ingredients. You're hiring Gordon Ramsay to cook you a Michelin star meal, believing his expertise will create something far better than you ever could on your own. These managers use a variety of strategies to try and get that edge. They perform deep dive research into companies, analyzing balance sheets, meeting with CEOs, and trying to find undervalued stocks, the hidden gems, before anyone else does. This is called stock selection. They also engage in market timing, trying to predict the ups and downs of the market. They might sell off a bunch of stocks when they think a recession is coming, or pile into tech stocks when they believe a boom is on the horizon. They are constantly buying, selling, and repositioning the fund's portfolio based on their research, their forecasts, and sometimes their gut feeling. The allure is powerful. It taps into our desire for a hero, a guide, a Wall Street wizard who can navigate the stormy seas of the stock market for us. We see them on TV, confident and charismatic, talking about their complex strategies and their high-conviction picks. We read about legendary investors like Peter Lynch, who achieved phenomenal returns for years. And we think, yes, that's what I want. I want a genius managing my money. Feels smarter. Feels safer. It feels like you're getting an exclusive advantage that the average person doesn't have. But that advantage, that perceived expertise, comes at a very, very steep price. This is where we need to talk about the single most destructive force in personal finance: fees. The cost of hiring that celebrity chef is called the expense ratio. Every single mutual fund has one. It's a percentage of your total investment that the fund company schemes off the top every single year to pay for the manager's salary, their team of analysts, their marketing budget, their fancy office in Manhattan, and the costs of all that buying and selling. For actively managed funds, this expense ratio typically ranges from 0.5% to well over 1.5%. Now 1%, that sounds like nothing, right? It sounds like a bargain for a financial genius. If I have $100,000 invested, 1% is just $1,000 a year. I can live with that if they're beating the market. But this is the most deceptive and dangerous piece of math in the entire investment industry. That small 1% fee is not a flat fee. It's a parasite that feeds on your growth year after year, and its true cost is magnified exponentially by the power of compound interest. Let's run a simple scenario. Imagine you and your friend both invest $50,000 for retirement. You both earn an average annual return of 8% over 30 years. The only difference is the fee. Your friend invests in a low-cost fund with a fee of just 0.1%. You, on the other hand, invest in an actively managed fund with a 1% expense ratio. The difference is only 0.9%. Seems trivial. After 30 years, your friend, paying the tiny 0.1% fee, would have her investment grow to approximately $475,000. Not bad at all. But you? Your final balance, after that tiny 1% fee has been chipping away at your returns every single year, would be only $380,000. That seemingly insignificant 0.9% difference in fees didn't just cost you a few $1,000s. It cost you nearly $100,000. It vaporized almost a quarter of your potential nest egg. It's the equivalent of 9 full years of your initial investment gone. Poof. Not because of a market crash, not because of bad investment choices, but because of a fee you probably never even noticed. And the expense ratio is just the beginning. It's the fee they have to tell you about. Actively managed funds also have other, less obvious costs. Because they are constantly buying and selling stocks, they rack up significant trading commissions and other transaction costs. These costs aren't included in the expense ratio, but they are passed directly onto you, the investor, acting as another drag on your performance. It's like paying for the expensive restaurant meal and then getting a separate bill for the electricity used to cook it. When you add it all up, the total cost of an actively managed fund can easily approach 2% per year. Think about what that means. If the market returns 8% in a given year, your fund manager has to generate a 10% return just for you to break even with the market. They are starting the race 100 yards behind the starting line, and they have to do it year after year after year. It's an almost impossible hurdle to clear. So you're paying a premium for a promise. The promise of a genius who can navigate the storms and find the hidden treasure. The question is, does that promise hold up? After you factor in all those costs, after you account for human error and bad luck, are these Wall Street wizards actually delivering? Or is there a simpler, cheaper, and shockingly more effective way to build wealth? That's the billion-dollar question we need to answer. To find that simpler way, we have to travel back in time. Not to the Roaring '20s or the Great Depression, but to the seemingly buttoned-up world of 1970s finance. And we need to meet a man who was, at the time, considered a failure. His name was John C. Bogle, but everyone called him Jack. And Jack Bogle was about to launch a revolution that would make him the arch-nemesis of Wall Street and the quiet hero of millions of regular investors. Bogle had just been fired from his high-flying job as the head of a major mutual fund company, Wellington Management. He'd made a bad bet on a merger, and in the unforgiving world of high finance, he was out. But this setback gave him time to think, to obsess over a single nagging idea that had been bubbling in his mind for years. An idea he first explored in his senior thesis at Princeton University back in 1951. The idea was deceptively simple, yet it flew in the face of everything the investment industry stood for. At the time, the entire business model of Wall Street was built on a single promise. We are the experts. We are smarter than the market. Give us your money, pay us a handsome fee, and our brilliant analysts and star fund managers will pick the winning stocks and generate massive returns for you. It was a story everyone bought into. Investing was seen as a game of skill, a battle of wits, and you paid top dollar to have the best night fighting for you. But Bogle, a man obsessed with numbers and data, saw a fatal flaw in this story. He looked at the performance of hundreds of actively managed funds over decades, and what he found was a dirty little secret. The vast majority of them failed. They didn't beat the market. In fact, after you subtracted their fees, most of them significantly underperformed the market. Think about it this way. Imagine all the professional investors in the world are sitting around a giant poker table. They're all trading stocks with each other. For every brilliant investor who sells a stock right before it drops, there has to be another investor on the other side of that trade who bought it. For every genius who buys a stock right before it soars, someone else had to sell it. Before you account for any costs, their collective performance, by definition, is the market's performance. They are the market. It's a zero-sum game, but it's actually worse than that. It's a negative-sum game. because every time they make a trade, a broker takes a cut. Every year, the fund managers take their hefty management fee. The company pays for slick marketing brochures and fancy downtown offices. All these costs act like a constant, relentless anchor, dragging down the overall returns of the group. Bogle realized that as a whole, the group of active investors is mathematically doomed to underperform the market by the precise amount of the costs they incur. This was his cost matters hypothesis. It was financial heresy. He was essentially saying that the entire industry, with its legions of Ivy League MBAs and its complex financial models, was a giant illusion. They weren't adding value, they were extracting it. They were playing a loser's game, and the only guaranteed winner was the house. So, this led Bogle to his revolutionary world-changing idea. If beating the market is a fool's errand for the vast majority of professionals, why even try? If the costs of trying are what cause you to lose, what if you could eliminate those costs? What if, instead of trying to find the single needle in the haystack, you just bought the whole haystack? The haystack in this case was the stock market itself. Specifically, an index that represents the market, like the Standard & Poor's 500, or the S&P 500. This is just a list of the 500 largest and most influential public companies in the United States. Think Apple, Microsoft, Amazon, Johnson & Johnson. It's a cross-section of American corporate power. Bogle's idea was this: create a new kind of mutual fund, one with no star manager, no team of brilliant analysts, no high-stakes bets on which stock will be the next big thing. This fund would simply, automatically, and robotically buy all 500 stocks in the S&P 500 index, in the exact same proportion as the index itself. If Apple made up 5% of the index's value, the fund would put 5% of its money in Apple. If Ford was 0.5%, the fund would put 0.5% in Ford. And then it would do almost nothing. It would just hold these stocks. A strategy we now call passive investing. Because there was no expensive manager to pay, no massive research department, and very little trading, the costs could be slashed to a bare minimum. The goal was no longer to beat the market. The goal was to be the market, to mirror its performance exactly, and deliver that return to the investor minus a tiny, almost negligible fee. In 1975, using the ashes of his old career, Jack Bogle founded a new company he called the Vanguard Group. He built it on this radical new philosophy, and in 1976, he launched the world's first publicly available index fund, the first index investment trust, which would later be renamed the Vanguard 500 Index Fund. Wall Street's reaction was not just skeptical, it was openly hostile. They laughed at him. They called his creation Bogle's folly. They mocked the very idea of willingly accepting average returns. A competitor famously produced a poster that declared indexing to be un-American. The message was clear: striving for average is for losers. Real Americans try to win. The fund was a commercial failure at first. Bogle hoped to raise $150 million in its initial offering. He raised just over $11 million. It was so small, he couldn't even afford to buy all 500 stocks in the index, and had to settle for a smaller sample. The industry hated the index fund because it was a direct threat to their entire existence. Their value proposition was based on skill, on being smarter than everyone else. Bogle's fund implied that their skill was an illusion and their fees were a ripoff. It was a simple, elegant mathematical argument, and they had no good answer for it. So they ridiculed it instead. But Bogle was offering something more profound than just a low-cost investment. He was democratizing finance. For the first time, an ordinary person, a teacher, a plumber, a doctor, could achieve the same results as the biggest Wall Street institutions, simply by buying one fund. They didn't need to spend hours researching stocks. They didn't need a fancy broker. They didn't need to be rich. They just needed the discipline to buy a slice of the entire American economy and hold on for the long term. It was a declaration of independence for the small investor. So the battle lines were drawn. On one side, you have active management, the promise of genius, the allure of beating the market, the highly paid, confident experts who claim they can navigate the treacherous waters of the market and find hidden treasure. It's exciting, it's compelling, and it's very, very expensive. On the other side, you have Bogle's folly, passive indexing, the humble admission that you can't predict the future, the simple strategy of owning everything and letting the power of the market do the work for you. It's boring, it's disciplined, and it's incredibly cheap. The theory was brilliant. The logic seemed unshakable. But Wall Street's mockery raised a valid point. Is average really good enough? Can you truly build life-changing generational wealth by simply settling for the market's return? The actual real-world results of this grand experiment, played out over the next 4 decades, would end up shocking everyone, including perhaps Jack Bogle himself. The launch of the first index fund in 1976 wasn't met with a standing ovation. It was met with a chorus of laughter. The fund, initially called the First Index Investment Trust, was immediately nicknamed Bogle's Folly. The financial industry, an industry built on the myth of the stock-picking genius, saw this idea as an attack on their very existence. A poster circulated by a rival brokerage firm showed a picture of Uncle Sam with the caption, "Help stamp out index funds. Un-American." They argued that settling for average was a loser's game, a surrender. Why would anyone willingly accept mediocrity when they could pay a professional to deliver excellence? The fund's initial public offering was a spectacular failure. The goal was to raise $150 million. It raised a pathetic $11 million. It was so small it couldn't even afford to buy all 500 stocks in the S&P 500. It had to settle for the biggest 280. The experiment was on the verge of collapsing before it even began. To understand why this simple idea was so hated, so viscerally rejected, you have to understand the world it was born into. You have to understand the philosophy of its Goliath: active management. For a century, active management was the only game in town. It wasn't just an investment strategy, it was a belief system, a culture. At its core is a seductive promise: we can beat the market. We are smarter, faster, and have better information than everyone else. We can sift through the thousands of companies out there, separate the winners from the losers, and deliver you returns that crush the average. The face of this promise wasn't a computer algorithm, it was a person. The star fund manager. These weren't just analysts, they were financial rock stars. Think of a celebrity chef. You don't go to their restaurant for a simple sandwich. You go for their unique creation, their secret sauce, their artistic flair that transforms common ingredients into a masterpiece. The star fund manager was the Gordon Ramsay of Wall Street. They were the maestros, the wizards who could read the tea leaves of the market, feel its pulse, and make bold, brilliant moves. Names like Peter Lynch of the Fidelity Magellan Fund became legendary. In the 80s, he was an investment god, delivering returns that seemed to defy gravity. People didn't just invest in his fund, they invested in him. They read his books, they watched his interviews, they hung on his every word. This is the psychological genius of active management. It appeals to our most basic human instincts. We want to believe in heroes. We want to believe that there are special people with special skills who can lead us to the promised land. It feels better to hitch your wagon to a celebrated genius than to a boring automated list of stocks. It's also an appeal to ego. Owning an actively managed fund felt like you were part of an exclusive club. You weren't just buying the market, you were smarter than that. You had hired a top mind to work for you to outwit the masses. So what do these managers actually do all day to justify their star status? They engage in a relentless, full-contact sport of financial analysis. Their teams of Ivy League MBAs work 80-hour weeks, poring over balance sheets, income statements, and cash flow reports. They build complex financial models to project a company's future earnings. They conduct what's called fundamental analysis, trying to determine a company's intrinsic value and buy it for less. They fly across the country to visit company headquarters, to kick the tires, to interrogate the CEO and get a gut feeling about their leadership. They analyze macroeconomic trends, interest rates, inflation, geopolitical events, trying to predict which way the economic winds will blow. Based on all this research, they make 2 critical decisions. First, stock selection: which specific companies to buy. Will Apple outperform Google? Is Ford a better bet than GM? Second, market timing: when to buy and sell. Should they be heavily invested in stocks right now? Or should they pull back and hold more cash, anticipating a downturn? It is a constant, high-stakes game of chess against the entire market. They are actively making bets, moving pieces, trying to outmaneuver millions of other smart, well-informed investors who are all trying to do the exact same thing. And for this white-glove, bespoke service, you pay a premium. A hefty premium. This is where the magic of the sales pitch meets the cold, hard reality of math. This premium is called the expense ratio. It's a small percentage, usually between 1 and 2% of your total investment, that is skimmed off the top every single year to pay for everything: the manager's multi-million-dollar salary, the team of analysts, the fancy corner office, the research databases, the trading costs. 1%. It sounds like nothing, right? It's the single most deceptively destructive number in personal finance. Wall Street loves it because it sounds harmless. It's just a penny on the dollar, they'd say. But it's not a one-time fee. It's a relentless annual parasite that feeds on your returns. It's a tax on your future. Imagine you're running a marathon. An active fund manager is like a world-class runner who promises to get you to the finish line faster. But to hire him, you have to agree to run the entire race wearing a backpack with a 20-pound weight in it. The index fund, on the other hand, is just an agreement to run at the same pace as the average of all runners. But you get to run with no backpack. Year after year, that 20-pound weight, that 1 or 2% fee never goes away. When the market is booming, you might not notice it. Your account is going up, you're making money, who cares about a tiny fee? But it's there, creating a drag, ensuring your finish time is always slower than it could have been. And when the market is flat or down, the fee doesn't take a vacation. It's still there, pulling money out of your account, making your losses even worse. Over an investment lifetime of 30 or 40 years, this tiny-sounding fee doesn't just reduce your returns. It can consume a third, sometimes even half of your potential nest egg. It's the difference between a comfortable retirement and a lavish one. It's the difference between leaving a modest inheritance and creating true generational wealth. This was the hidden truth that Bogle's folly was built upon. The entire active management industry was predicated on the idea that their stock-picking brilliance could consistently overcome the massive headwind of their own fees. They weren't just competing against the market. They had to beat the market by enough of a margin to cover their costs and still deliver a superior return to the investor. It's like telling a high jumper they have to clear the bar, but they have to do it from a 2-foot trench. So here we have the two contenders standing in the ring. In one corner, the heavyweight champion of the world, active management. It's glamorous, it's expensive, it's confident. It's backed by a century of tradition and the entire marketing might of Wall Street. It's got the star power, the stories, the promise of glory. In the other corner, the challenger, a scrawny, laughed-at underdog. The index fund. It's boring. It's cheap. It has no story, no hero. Its only promise is that you will never be a star, but you will never fail. You will get the market's return, no more, no less, minus a tiny, almost imperceptible cost. The stage was set for a battle of philosophies that would span decades. A battle between human genius and humble arithmetic. Between the promise of beating the average and the guarantee of capturing it. The question was no longer theoretical. As Bogle's folly survived its near-death experience at birth and began to slowly, quietly gather assets, the grand experiment had begun. What would actually happen when these two strategies were tested, not in a textbook, but in the brutal, unpredictable arena of the real world, through the raging bull markets of the 80s and 90s, the gut-wrenching dot-com crash, and the global financial crisis? Which backpack would you rather be wearing when the gun went off? To answer that, let's step into a time machine. The year is 1977. Star Wars is blowing up the box office, the first Apple II computer is hitting shelves, and a relatively unknown 33-year-old man named Peter Lynch is handed the keys to a small, obscure mutual fund at Fidelity called the Magellan Fund. At the time, it was a tiny puddle of money, just $18 million in assets. Nobody was paying attention. But the backpack this man was wearing, it wasn't just expertly crafted. It was practically enchanted. For the next 13 years, from 1977 to 1990, Peter Lynch didn't just beat the market. He humiliated it. He didn't just win the race. He lapped the competition multiple times while waving to the crowd. His average annual return was an absolutely staggering 29.2%. Let me put that number in perspective for you. The S&P 500, the very benchmark he was supposed to be competing against, did great during that time, but it was nowhere close. If you had invested $10,000 with Peter Lynch in 1977, by the time he retired in 1990, you would have had over $280,000. 10 grand. That's it. In 13 years. That's the kind of life-changing generational wealth that active management promises. This wasn't a fluke. It wasn't one lucky bet. It was a sustained 13-year masterclass in stock picking. How did he do it? His philosophy was deceptively simple. Invest in what you know. He famously talked about how his wife, Carolyn, came home raving about a new brand of pantyhose she bought at the supermarket called Legs. He looked into the parent company, Hanes, saw the potential, and made a fortune for his investors. He noticed people lining up for coffee and donuts at a local chain. So he invested in Dunkin' Donuts. He saw his kids playing with Nintendo. He bought Taco Bell, the Gap, Volvo. He wasn't using some secret algorithm from a black box in a basement at MIT. He was using his eyes. He was on the ground doing what he called kicking the tires. He believed that if you did your homework, if you really understood a business, you could gain an edge before the rest of Wall Street caught on. He was a human supercomputer, a relentless workaholic who reportedly worked 6 or 7 days a week, 12 to 14 hours a day, reading thousands of annual reports, meeting with hundreds of company executives every year. At its peak, the Magellan Fund owned over 1,400 different stocks. He wasn't just buying blue-chip giants. He was finding small, fast-growing companies in boring industries that no one else was looking at. He was the living, breathing embodiment of the active manager ideal. He was the brain. He was the expert you paid for. And by the time he stepped down, that tiny $18 million fund had ballooned into a $14 billion behemoth, the largest mutual fund in the world. He was a rock star. His book, One Up on Wall Street, became a Bible for an entire generation of investors who believed they, too, could find the next big thing. So, when you ask which backpack you'd want looking at Peter Lynch, the answer seems blindingly obvious. You want that one. You want the one packed by the genius, the legend, the man who proved it was possible not just to beat the market, but to leave it in the dust. This is the siren song of active management. It's the story they sell you. And it is a powerful, compelling, and incredibly seductive story. But while Peter Lynch was becoming a Wall Street deity, a different story was unfolding. It was a much quieter, less glamorous story. In fact, it was a story that almost no one wanted to hear. A year before Lynch took over Magellan in 1976, a man named John C. Bogle, or Jack as everyone called him, launched a fund with a radically different, almost heretical idea. Bogle's backpack wasn't packed with secret maps or high-tech gear. It was packed with everything. All the gear. The whole store. His idea was to create a fund that didn't try to beat the market at all. Instead, it would simply be the market. It would buy and hold all 500 stocks in the S&P 500 index, in the exact same proportions as the index itself. No genius stock picker. No kicking the tires. No trying to find the next Dunkin' Donuts. Just buy the whole haystack, not the needle. The goal was not to win, but to simply guarantee you wouldn't lose to the market itself. The fund was called the First Index Investment Trust, and the financial industry hated it. They didn't just dislike it, they treated it with open contempt. It was mocked relentlessly. It was nicknamed Bogle's Folly. Competitors called it a formula for guaranteed mediocrity. One poster produced by a major brokerage firm showed a picture of Uncle Sam and declared, "Help stamp out index funds. Indexing is un-American." The argument was that trying to be average was a rejection of the competitive spirit that built the country. The entire Wall Street establishment, which made its billions on high fees from actively managed funds, saw this as an existential threat. If you could get market returns for a tiny fraction of the cost, why would anyone ever pay them their hefty 2% fees again? The launch of Bogle's fund was a catastrophic failure. The underwriters, the big banks who were supposed to help sell it, basically walked away at the last minute. The goal was to raise $150 million. When the dust settled, they had scraped together a pathetic $11.3 million. It was so small they couldn't even afford to buy all 500 stocks in the index, so they had to start by only buying the 200 largest ones. By every conventional measure, it was dead on arrival. So now we have our two contenders, our two backpacks in the real world. In one corner you have the heavyweight champion Peter Lynch, the symbol of human ingenuity, relentless research, and the promise of outsized, life-altering returns. He represents the belief that with enough skill and hard work, a brilliant individual can conquer the chaos of the market. He is the argument for active management. In the other corner you have the scrawny, ridiculed underdog, Bogle's Folly, the first ever index fund. It represents a philosophy of humility, of mathematical reality, and the belief that the market as a whole is a force too powerful and efficient to be consistently outsmarted. It is the argument for passive investing. One sells you a dream, the other sells you a guarantee, the guarantee of average. One is exciting, aspirational, and heroic. The other is, well, it's boring. It's the financial equivalent of eating your vegetables. For 13 years, Peter Lynch proved that the dream was real. He was the exception that seemed to disprove the rule. But here's the billion-dollar question that would come to define the next 40 years of investing for millions of Americans. Was Peter Lynch truly the rule? Or was he the beautiful, dazzling, once-in-a-generation exception? And what about all the other thousands of managers who wore the same kind of backpack, who charged the same high fees, and who promised to be the next Peter Lynch? How did they do? And what happened to that pathetic little fund? That un-American folly that nobody wanted? How did its story play out when the bell rang for round after round, decade after decade? That's where the real battle begins. The first few years were quiet. The first index investment trust, later renamed the Vanguard 500, didn't come out of the gate with a knockout punch. It just did exactly what it promised. When the S&P 500 went up 1%, the fund went up 1% minus a tiny, almost imperceptible fee. When the market went down, the fund went down. It was predictable. It was boring. And on Wall Street, boring doesn't sell newsletters. It doesn't get you on the cover of Forbes or Fortune magazine. Glory in the late 1970s and through the 80s belonged to the titans, the stock pickers, the modern-day gladiators who entered the arena of the market each morning to do battle. And their undisputed emperor was a man named Peter Lynch. Lynch ran the Fidelity Magellan Fund, and he wasn't just a fund manager, he was a rock star. From 1977 to 1990, he delivered an average annual return of over 29%. 29% a year, for 13 years straight. To put that in perspective, $1,000 invested with him in 1977 would have turned into over $28,000 by the time he retired. He didn't just beat the market, he humiliated it. He lapped it. He made the S&P 500 index look like a horse and buggy trying to race a fighter jet. And the story was intoxicating. Lynch was the ultimate hero. He wasn't some Wall Street quant with a supercomputer. He was a guy who famously said you could find the best investments at the mall or by talking to your kids. He invested in what he knew. Hanes because his wife liked the pantyhose. Dunkin' Donuts because he liked the coffee. It was a story of common sense, hard work, and genius triumphing over the cold, faceless market. People poured money into his fund. They believed in him. He was the proof that a brilliant mind could, in fact, outsmart the masses. This was the central conflict, the two competing gospels of investing. On one side, you had the gospel of the guru. It preached that the market was a puzzle, and with enough skill, enough research, enough sheer brain power, you could solve it. It was a story of human achievement, of the individual hero slaying the dragon. It was aspirational. It was exciting. And it came with a price tag, a fee for the hero's services. On the other side, you had John Bogle's new, humble gospel. The gospel of the haystack. It preached that the market wasn't a puzzle to be solved, but a giant haystack filled with thousands of needles. The gurus, the heroes, were spending all their time and your money trying to find the sharpest needles. But Bogle's idea was simpler. Just buy the whole haystack. Why pay someone a fortune to search for needles when you can own all of them, the sharp and the dull, for next to nothing? It was a story of humility, of accepting that you can't predict the future. And it was, frankly, a much less exciting story to tell at a cocktail party. For the first decade or so, the battle was a slugfest. In some years, the star managers, led by Lynch, would land incredible blows, their returns soaring past the index. The headlines would read, "Geniuses prove their worth." In other years, the market would have a great run, and the simple low-cost index fund would quietly pull ahead of the majority of the active managers trying to be clever. The results were messy. There was no clear winner. But something else was happening beneath the surface, a hidden dynamic that most people never saw. It's a powerful psychological trap called survivorship bias. We were all watching Peter Lynch. We saw his stunning victories. But for every Peter Lynch, there were hundreds of other managers who tried to be heroes and failed spectacularly. Their funds performed poorly, lost money, and were eventually quietly shut down or merged into other funds. They were erased from history. We don't see the losers. We only see the champions standing on the podium, and we trick ourselves into believing that winning is common, that becoming a champion is a realistic goal for everyone. The index fund, however, could never be erased. It couldn't be shut down for poor performance because its only job was to be the performance. It was the benchmark. It was the constant, the unmoving measure against which all the would-be heroes were judged. It just kept going year after year, patiently absorbing the entire market's return. And it had a secret weapon, an invisible advantage that grew more powerful with every passing day. To understand it, imagine two professional cyclists. They are genetically identical with the same training, the same diet, and the same billion-dollar carbon fiber bicycle. They are perfectly matched in every way. They set off on a 100-mile race. But there's one tiny difference you can't see. One cyclist is wearing a perfectly tailored, aerodynamic skin suit. The other is wearing a regular t-shirt and shorts. For the first mile, you wouldn't notice a difference. For 5 miles they might still be neck and neck. But over the full 100 miles, the tiny, almost imperceptible air resistance from the t-shirt, that little bit of drag, becomes a crushing burden. The cyclist in the skin suit will pull away, slowly at first, then decisively, leaving the other exhausted and defeated. In the world of investing, fees are that drag. Active funds were the cyclists in the t-shirts. They were paying for the star managers, the teams of analysts, the expensive research, the constant buying and selling of stocks, which racked up trading commissions. All of these costs, year after year, created a constant, relentless drag on their performance. The index fund was the cyclist in the skin suit. With no star manager to pay, no team of analysts, and very little trading, its costs were breathtakingly low. Its drag was almost zero. So the active managers didn't just have to be smart enough to beat the market. They had to be so brilliant, so clairvoyant, that they could pick stocks that would not only outperform the average, but outperform it by enough to cover all of their costs, all of that aerodynamic drag, and still come out ahead. They weren't just racing the market. They were racing the market while riding with the brakes slightly on. And as the years turned into decades, the math became brutal. The drag compounded. What started as a small gap became a canyon. The evidence began to mount, not in breathless magazine articles, but in cold, hard academic studies. Study after study began showing the same shocking result. Over any long period of time, 10, 15, 20 years, the vast majority of active fund managers, the supposed heroes, failed to beat the simple, boring, low-cost index fund. Not just some of them. Most of them. Over 80 to 90% of them, depending on the study and the time frame. The gospel of the guru was starting to crumble under the weight of its own promises. But the most stunning indictment didn't come from an academic in an ivory tower or from John Bogle, the index fund's creator. It came from the hero himself. Peter Lynch, the undisputed king, the Michael Jordan of stock picking, gave the game away. In his own books he wrote, and I'm paraphrasing here, that the average person is probably better off in a no-load index fund. Think about that. The greatest active manager in history, the man whose success was the single best argument for active management, was telling people not to try and find the next him. He was telling them to buy the haystack. Why? Because he knew. He knew how hard it was. He knew he was a statistical anomaly, a 1 in a million outlier. He understood that the real danger for most people wasn't just picking a bad fund, but chasing performance, jumping from one hot manager to the next, always buying high and selling low, and getting eaten alive by fees along the way. The battle of the 80s was over. The hero had won his personal victory and retired. But the war of ideas was just heating up. The evidence was now on the table. The question was no longer theoretical. It was a mathematical certainty. And as the world headed into the tech boom of the 1990s, a whole new generation of investors would have to choose which gospel to believe in, often with their entire life savings on the line. And that choice would be put to the most extreme test imaginable in the crucible of the 1990s. The decade didn't just bring us dial-up modems and sitcoms about nothing. It unleashed a financial mania unlike anything seen in generations. The internet was no longer a government project or a niche academic tool. It was the new frontier, a digital Wild West, and Wall Street was selling tickets, shovels, and dreams of gold. At the heart of this gold rush was a new breed of celebrity, the tech fund manager. These weren't the old-school, cigar-chomping value investors of yesteryear. They were young, charismatic, and they spoke a new language of eyeballs, burn rates, and first-mover advantage. They appeared on the cover of Forbes and Wired, treated less like financiers and more like rock stars. And for a while they seemed to possess a kind of magic. They could point to some obscure company with a nonsensical name, no profits, and a vague business plan, and within months, its stock would be worth billions. Let's imagine one of these figures, a composite of the era's biggest names. We'll call him Michael Thorne, manager of the Pegasus Tech Growth Fund. In 1997, Thorne was a god. He had a knack for finding the companies that everyone was talking about. He didn't care about price-to-earnings ratios. He cared about disruption. He argued that old metrics were useless for valuing this new paradigm. He was buying companies like GeoCities, TheGlobe.com, and a little online pet supply store called Pets.com. His fund's performance was breathtaking. While the overall market was having a great run, the Pegasus fund was stratospheric. A 60% return in 1997, an 85% return in 1998, and in 1999, an unbelievable 150% return. Now imagine you're an investor in the late 90s. You have two choices. On one hand, you have Michael Thorne and the Pegasus Fund. He's on TV every night, confidently predicting the next big thing. Your neighbor who invested with him just put a new pool in his backyard. The financial magazines are calling him a visionary, a new economy prophet. He is the living, breathing embodiment of the promise of active management, a brilliant mind, navigating the complex markets to deliver life-changing wealth to his followers. He is finding the needles in the haystack. And in the other hand, you have the Vanguard 500 Index Fund, the Bogle-inspired behemoth. What was it doing while Michael Thorne was shooting for the moon? It was just buying the haystack. For every high-flying tech darling Thorne was picking, the index fund was also buying it. But it was also buying Procter & Gamble. It was buying Johnson & Johnson. It was buying Coca-Cola, Ford, and Exxon. It was buying hundreds of old economy companies that the new prophets declared were dinosaurs, destined for extinction. The index fund's returns were good, great even by historical standards. It was up over 30% in 1997, but 30% felt like a failure when your neighbor was getting 60%. The marketing for active funds was relentless and seductive. Why settle for average? The ads would ask. Why own the losers when our experts can pick the winners? To the average person caught up in the mania, the logic of indexing seemed absurd. Why would you deliberately buy the stocks that were going nowhere, when a genius like Michael Thorne could give you only the ones that were going to the moon? It felt like tying one hand behind your back. The discipline of indexing felt like a punishment in a world where it seemed everyone else was getting rich overnight. The pressure to abandon the slow and steady path was immense. Financial advisors who recommended index funds were seen as dinosaurs themselves, uninspired and out of touch. People pulled their money out of diversified funds and piled it into tech-focused funds like Pegasus. The Gospel of Bogle felt like an ancient text in a world that had discovered electricity. And Michael Thorne's fund kept growing. The more money that poured in, the more he had to invest. And since his mandate was tech growth, he just kept buying more and more of the same handful of popular tech stocks. This created a feedback loop. His buying pushed their prices higher, which made his fund's performance look even better, which attracted even more investors, which gave him more money to push the prices higher still. The entire sector became a massive echo chamber, where sky-high valuations were justified by the fact that they were, well, sky-high. If a company with no revenue was worth $10 billion yesterday, why couldn't it be worth $20 billion tomorrow? In this new paradigm, the sky was no longer the limit. But underneath the surface, a dangerous concentration of risk was building. The Pegasus Fund and hundreds of funds like it weren't just betting on tech. They were betting on a very specific, very narrow slice of the tech world, unprofitable and proven internet companies. They had abandoned the core principle of diversification in their quest for spectacular returns. They had, in essence, built a beautiful mansion on the edge of a cliff, convinced that the laws of gravity had been repealed. The index fund, meanwhile, just kept doing its boring, methodical work. It bought more tech stocks as they grew to become a larger part of the overall market, yes. But it never stopped buying toilet paper and toothpaste and insurance. Its portfolio was a reflection of the real, tangible American economy, not just the speculative, digital one. It was diversified not just across companies but across entire sectors. Its foundation wasn't built on a cliff edge. It was spread across the entire continent. Then came March of 2000. It didn't happen with a single dramatic crash. It was a slow, sickening realization that the party was over. A few big tech companies missed their earnings estimates. A report questioned the sector's valuations. The confidence that had seemed so unshakable began to crack. And then the selling started. And because everyone was crowded into the same few stocks, the exit door was impossibly small. The feedback loop that had driven prices to the moon now went into a brutal reverse. As prices fell, funds like Pegasus had to sell stocks to meet investor redemptions. Their selling pushed prices down further, which triggered more panic and more redemptions, forcing them to sell even more. The new paradigm stocks were exposed for what they were: ideas, not businesses. Pets.com, which had spent millions on a Super Bowl ad, went bankrupt in November 2000. Webvan, the billion-dollar grocery delivery service, was gone by 2001. TheGlobe.com, which had the biggest first-day IPO pop in history, saw its stock fall from $97 to less than 10 cents. And what about Michael Thorne and the Pegasus Tech Growth Fund? It was a bloodbath. The fund lost over 80% of its value. The 150% gain from 1999 was wiped out, and then all the gains from 1998 and 1997, and then it just kept falling. The life savings of teachers, doctors, and mechanics who had believed in the promise of a stock-picking genius evaporated into thin air. Thorne went from a celebrated prophet to a pariah. His mansion on the cliff had crumbled into the sea. And the Vanguard 500 index fund? It went down too. You cannot own the entire market and be immune when the market falls. The S&P 500 fell significantly during the dot-com bust. But here's the crucial difference. It didn't get wiped out. The investors who held it lost value on paper, but they didn't lose everything. Why? Because for every Pets.com that went to zero, they still own Procter & Gamble, which was busy selling Tide. For every Webvan that imploded, they still own Johnson & Johnson, which was selling Band-Aids. The boring companies, the dinosaurs, were the bedrock that kept the entire portfolio from collapsing. The diversification that looked like a weakness in 1999 was revealed to be its greatest, most profound strength in 2001. The haystack, it turned out, was fire retardant. The needles were not. The dot-com crash was more than a financial event. It was a brutal, real-world lesson in investment philosophy. It was the first great public trial for the theory of indexing, and the verdict was clear. The seductive promise of a star manager finding the next big thing could lead to spectacular, temporary gains, but it also carried the risk of absolute, permanent ruin. The boring, average approach of simply buying and holding the entire market was designed not just for the booms, but to survive the inevitable busts. It was a strategy built on humility, on the admission that no one can consistently predict the future. And for the generation of investors who had their fingers burned chasing the profits of the new economy, that humility suddenly looked a lot like wisdom. And just like that, the floodgates opened. The 2000s weren't just the hangover from the 90s party. They were a decade-long lesson in financial gravity. The money that had rushed into new paradigm tech funds, chasing genius stock pickers who promised to rewrite the rules of economics, now began a quiet, steady exodus. It flowed away from the high-rise offices in Manhattan and towards a sleepy valley in Pennsylvania, home of Vanguard. It was a migration of capital driven not by greed, but by a newfound respect for what could go wrong. Investors started looking at their brokerage statements, seeing the outrageous fees they were paying for funds that had just lost 50, 60, 70% of their value, and they asked a very simple, very powerful question: what exactly am I paying for? The answer, for millions, was not enough. And as this realization dawned, a revolutionary piece of financial technology, which had been quietly gestating since the early 90s, was perfectly positioned to explode onto the scene. It was called the Exchange Traded Fund, or ETF. And if the mutual fund was the reliable family sedan of indexing, the ETF was a fleet of lightning-fast delivery drones, ready to bring low-cost diversification to every single person with a brokerage account, instantly. You see, traditional index mutual funds were a bit clunky. You could only buy or sell them once a day at the closing price. It felt old-fashioned, but the ETF was different. It was a bundle of stocks just like a mutual fund, but it traded on the stock exchange all day long just like a single share of Apple or Microsoft. The first and most famous of these was the SPDR S&P 500 ETF, ticker symbol SPY. They called it the Spider. And it completely changed the game. Suddenly, you could get exposure to the entire US stock market with a single click, for a tiny fraction of the cost of an active fund. It was liquid, it was transparent, and most importantly, it was cheap. Incredibly cheap. This innovation lit the fuse on one of the most brutal price wars in financial history. It was a race to the bottom, and the only winner was the individual investor. Vanguard, the pioneer, was already cheap. But now, competitors like BlackRock with its iShares ETFs and State Street with their SPDRs, not to mention Schwab and Fidelity, all jumped into the fray. They started slashing expense ratios, the annual fee you pay to own a fund, from fractions of a percent to hundredths of a percent. It became a marketing weapon. One firm would announce an S&P 500 fund for 0.05%, and a month later, a competitor would launch one for 0.04%. It was a fight for every basis point, every hundredth of a penny on the dollar. Think about how insane this is. In what other industry do the biggest players viciously compete to charge you less money? Imagine Nike and Adidas fighting to sell you shoes for cheaper and cheaper, until they cost just a few cents. That's what happened in the world of investing. The result was that the core argument of active managers, that their expertise was worth the extra 1 or 2% fee, began to look mathematically absurd. How could a manager, after fees, possibly hope to beat an index that was now essentially free? The hurdle just got higher and higher, until it was practically insurmountable for the vast majority. The active fund industry was on the ropes. They had been exposed by the dot-com bust, And now they were being systematically dismantled by the relentless cost-cutting efficiency of the ETF. But they still had one last powerful argument in their arsenal. It was the ace up their sleeve, the claim they saved for the darkest of days. Sure, we might underperform in a raging bull market when everything is going up. But when the crash comes, when the sky is falling, we will protect you. Our skill, our research, our ability to sell before the bottom falls out will preserve your capital. An index fund is a mindless robot. It will ride the market all the way down to zero. We are the seasoned pilots who know when to bail out. It was a compelling pitch. It preyed on our deepest fear, the fear of losing everything. And in 2008, that fear became a global reality. The subprime mortgage crisis metastasized into a full-blown financial meltdown. Lehman Brothers, a 158-year-old institution, vanished. Bear Stearns gone. AIG, the world's largest insurer, was on life support. The stock market wasn't just falling. It was in a terrifying, uncontrolled freefall. This was it. This was the moment active management was born for. This was their chance to prove their worth, to be the heroes, to justify their fees once and for all. So what happened? Did the star fund managers, with their armies of analysts and their sophisticated economic models, see the iceberg coming? Did they steer their clients' portfolios into the safe harbor of cash and government bonds, watching from the shore as the S&P 500 Titanic went down? The data is not just clear. It is brutal. They didn't. In 2008, the S&P 500 index lost a staggering 37%. And the average actively managed U.S. stock fund? It also lost a staggering 37.8%. They didn't just fail to protect their investors. On average, they performed slightly worse than the mindless index fund, all while charging their full, handsome fee for the privilege of losing your money. Of course, a tiny handful of managers did see it coming. John Paulson famously made billions betting against the housing market. But they were the exceptions, the statistical outliers that proved the rule. The vast, overwhelming majority of Wall Street's best and brightest were caught just as flat-footed as everyone else. They held the same banking stocks, the same consumer stocks, the same industrial stocks that were getting obliterated. Their promise of downside protection, the very cornerstone of their value proposition, was shattered. It was revealed to be a marketing myth, not a reliable strategy. The psychological impact of this failure cannot be overstated. If the dot-com bust was the first crack in the dam, the 2008 crisis was the explosion that blew it wide open. An entire generation of investors, from millennials just starting their 401(k)s to baby boomers watching their retirement accounts get vaporized, learned a hard and painful lesson. They learned that the people in charge, the supposed experts, often don't know any more than anyone else. They learned that paying a high fee for protection was like paying for an umbrella made of tissue paper in the middle of a hurricane. The aftermath of 2008 cemented a new world order in investing. Indexing was no longer the quirky, contrarian choice. It became the default. It became the sensible, logical, evidence-based foundation of a modern portfolio. The burden of proof had completely flipped. It was no longer on the index fund investor to explain why they weren't paying for a star manager. It was now on the active manager to prove, beyond a shadow of a doubt, why anyone on earth should pay them a premium for a service that had so spectacularly failed its ultimate test. The active management industry was now fighting for its very survival, and it was forced to evolve. It had to find new arguments, new strategies, and new ways to justify its existence in a world that was growing more skeptical by the day. The first counterattack from the world of active management wasn't a whisper. It was a roar. It was a fundamental rejection of the core premise of indexing. Vogel's argument for the index fund rested on a powerful academic theory, known as the efficient market hypothesis. In its simplest form, this theory says that all known information about a company, its earnings, its new products, its management scandals, is already baked into its stock price at any given moment. The market is a giant, hyper-intelligent weighing machine, constantly absorbing and reflecting new information instantly. If this is true, then trying to find an undervalued stock is a fool's errand. It's like trying to find a $20 bill on the floor of Grand Central Station during rush hour. By the time you see it, someone else has already picked it up. The index fund embraces this. It doesn't try to be clever, just buys the whole station. But active managers fire back. The market is not a perfect machine. It's a collection of people. And people are greedy, they're fearful, they're irrational. They argue that the efficient market hypothesis was a beautiful theory for a classroom, but it falls apart in the real world. The real world has manias like the dot-com bubble, where worthless companies were bid up to astronomical prices. It has panics like the crash of 2008, where perfectly good companies were sold off for pennies on the dollar. These, they argued, are not the signs of an efficient, rational machine. They are opportunities. An active manager, a real human being with experience and judgment, can see the madness for what it is. They can avoid the overhyped garbage during a bubble and courageously buy the quality companies when they're on sale during a crash. They are not just buying the whole market. They are selectively shopping for bargains, looking for that one company the market has misunderstood, mispriced, or completely ignored. They are the value investors in the mold of Benjamin Graham and Warren Buffett, sifting through the market's discarded items to find hidden treasure. The index fund, in their view, was a mindless drone, forced to buy more and more of a tech stock as its price became more and more insane, and then forced to sell it all the way down after the bubble popped. The active manager was the sane person in a room full of lunatics. Then came the second, more subtle and perhaps more powerful argument. It was an argument born from the very success of indexing itself. As trillions of dollars poured out of active funds and into passive index funds, a strange thing began to happen. The index itself started to become the market. Think about it. When you put $100 into an S&P 500 index fund, that fund doesn't make a judgment call. It is legally obligated by its prospectus to go out and buy a little bit of all 500 companies in their exact market cap proportions. It buys a lot of Apple, a little less Microsoft, and so on all the way down to the 500th company. It doesn't ask if Apple is overvalued. It doesn't care if the 500th company is on the verge of a breakthrough. Just buys. Active managers began to point out the dangerous distortion this creates. This massive, indiscriminate buying pressure from index funds can push the prices of the biggest companies ever higher, creating a self-fulfilling prophecy. The bigger they get, the more of every new index dollar they receive, which makes them bigger still. It creates a momentum loop that has little to do with the underlying value of the business. Active managers saw this as the ultimate irony. The more popular passive investing became, the less efficient the market became. The mindless tidal wave of index money was creating huge waves and mispricings that a skilled sailor, an active manager, could navigate and exploit. They could short the bloated, over-indexed giants and buy the forgotten, unindexed orphans that were being starved of capital. In a sense, they argued that index funds are parasites on the market. They only work because active managers are out there doing the hard work of price discovery, of researching companies and deciding what they're truly worth. If everyone indexed, the market would cease to function. No one would be there to punish a poorly run company by selling its stock or reward an innovative one by buying it. The market's brain would be removed, leaving only a twitching, reflexive beast. The third pillar of the active management comeback was perhaps the most emotionally resonant: downside protection. This argument hit index investors where they were most vulnerable: their fear. An index fund is a one-trick pony. It is always 100% fully invested. When the market is screaming upwards, that's fantastic. You capture all of the gains. But markets don't just go up. When the crash comes, an index fund is strapped to the front of the locomotive as it goes off the cliff. It will capture 100% of the losses, too. There is no break. There is no escape hatch. An active manager, on the other hand, has a full toolbox. If they see a storm brewing on the horizon, if valuations are stretched, if geopolitical risk is rising, if a recession looks imminent, they can act. They can sell stocks and raise cash, creating a buffer for the portfolio. They can rotate out of high-flying, risky sectors and into stable, defensive ones like consumer staples or utilities, companies that sell toothpaste and electricity, things people buy even in a downturn. They can use sophisticated option strategies to hedge the portfolio, buying insurance against a market fall. The sales pitch was simple and powerful. The index fund will make you rich in a bull market, but we will keep you rich in a bear market. For anyone who had lived through the terror of 2000 or 2008, watching their life savings get cut in half, this promise of a steady hand on the tiller, of a manager who could go to cash and protect their capital, was incredibly seductive. It transformed the fee they paid from a simple cost into an insurance premium against catastrophe. Finally, the active industry refined its focus. It conceded that, yes, maybe trying to beat the S&P 500, one of the most heavily researched and efficient markets on planet Earth, was a difficult game. But the world of investing is far larger than just 500 big American companies. What about small cap stocks, where many companies have zero Wall Street analysts covering them? What about emerging markets like Brazil or India or Vietnam, Where information is scarce, accounting standards can be murky, and local knowledge is paramount. What about niche areas like distressed debt or micro-cap companies? In these less traveled corners of the investment universe, the active managers argued, the efficient market hypothesis breaks down completely. These are not superhighways of information. They are dark alleys. And in a dark alley, having a guide, an expert who does on-the-ground research, meets with management and kicks the tires, isn't just a luxury, it's a necessity. Buying an index of these markets, they claimed, was just buying a basket of mediocrity and potential fraud. But a skilled manager could navigate the terrain, avoid the landmines, and uncover spectacular gems that the rest of the world had never even heard of. They repositioned themselves not just as stock pickers, but as specialists, as explorers in the inefficient frontiers of the market where true alpha, true outperformance, could still be found. This four-pronged counteroffensive was brilliant. It attacked indexing on grounds of logic, paradox, emotion, and specialization. It painted active managers as the rational shoppers in an irrational market, the saviors in a world distorted by passive flows, the protectors in a storm, and the expert guides in uncharted territory. The narrative had shifted. The question was no longer simply about fees. It was about philosophy, about safety, about whether you wanted a mindless robot or a seasoned captain navigating your financial future. The active management industry, left for dead, had found its voice again, and it was ready for the next round of the fight. And that next round began not with a bang, but with a crash. The year is 2008. The global financial system is teetering on the brink of collapse. Lehman Brothers, a titan of Wall Street, evaporates overnight. Bear Stearns is gone. The market is in a freefall, and for the first time in a generation, the simple, elegant promise of the index fund looks less like a guarantee and more like a liability. Because when the entire market is a sinking ship, being lashed to the mast isn't a strategy, it's a death sentence. An S&P 500 index fund had no choice. It was legally obligated to own the financial institutions that were imploding. It had to hold AIG as its stock price plummeted from over $1,000 to less than $10. It had to hold Washington Mutual, Wachovia, and Merrill Lynch as they raced towards oblivion. The index fund, the mindless robot, could not sell. It couldn't raise cash. It couldn't pivot to safer assets. Its only job was to perfectly mirror the market's catastrophic descent. Investors who had put their faith in passive investing watched, horrified, as their portfolios were cut in half, with no escape hatch in sight. This was the moment the active managers had been waiting for. This was their "I told you so." Their argument, once dismissed as an excuse for high fees, now sounded like prophecy. They argued that in a crisis you don't want a robot following a formula. You want a seasoned pilot who knows how to navigate a storm. A skilled manager could have seen the cracks forming in the subprime mortgage market. They could have sold their shares in over-leveraged banks. They could have moved their clients' money into cash, or into defensive sectors like consumer staples and healthcare that hold up better in a recession. They could have protected the downside. And downside protection became the new holy grail. It's a concept measured by something called the downside capture ratio. Sounds technical, but it's brutally simple. If the market falls by 10%, and your fund only falls by 8%, your downside capture ratio is 80%. You captured only 80% of the market's losses. For investors still nursing the wounds of 2008, the idea of a fund that could lose less when the market tanks was incredibly seductive. The sales pitch wrote itself. Sure, you might not capture all of the upside in a raging bull market, but we'll save your skin when the next crash comes. We're not just trying to make you money, we're trying to make sure you don't lose it. This philosophy, this focus on risk management, gave active management a new lease on life. But something else was happening in the background. A quiet revolution brewing in the halls of academia that would once again change the entire game. Financial researchers started digging deeper into the performance of those successful active managers. They asked a critical question. What were these star managers actually doing to beat the market? Was it magic? Was it a sixth sense for picking stocks? Or was it something else? What they discovered was a bombshell. A huge portion of the outperformance of legendary managers wasn't due to their brilliant, unique insights into individual companies. It was because they were systematically, and perhaps unconsciously, tilting their portfolios towards certain characteristics or factors that historically tended to outperform the broader market over time. Think of it like this. Imagine you're a basketball scout. You could try to find the one magic player who will be the next Michael Jordan. That's traditional stock picking. Or you could discover that, on average, players who are taller than 6'6" and have a vertical leap over 30 inches tend to be more successful. So you just build a team of players with those characteristics. You might not get Michael Jordan, but you'll probably have a very, very good team. These researchers found the financial equivalent of height and vertical leap. They identified several key factors. There was the value factor. Stocks that are cheap relative to their earnings or assets tend to outperform expensive ones. There was the size factor. Smaller companies tend to outperform larger ones over the long run. There was momentum. Stocks that have been going up recently tend to keep going up for a period. And quality. Companies with stable earnings, low debt, and strong balance sheets tend to deliver better risk-adjusted returns. This changed everything. It suggested that much of what passed for a manager's unique skill, their alpha, was actually just exposure to these well-known factors, or beta. And if it was just a formula, buy cheap stocks, buy small stocks, buy quality stocks, then you didn't need an expensive human manager to do it. A computer could do it. A low-cost index fund could be built to do it. And so a new product was born, the Smart Beta or Factor ETF. This was the ultimate hybrid. It was a passive fund, built on a rules-based index, with all the benefits of low costs and transparency. But it wasn't tracking a traditional index like the S&P 500. It was tracking an index of value stocks, or an index of small-cap stocks, or an index of high-quality stocks. It was an attempt to democratize the strategies of the best active managers to capture their secret sauce in a cheap, accessible package. Suddenly, the clean, simple line between active and passive was gone. It had completely blurred. The debate was no longer a binary choice between a cheap, dumb S&P 500 fund and an expensive, smart stock picker. The menu of options had exploded. You could now buy a passive fund that behaves like an active fund. You could get cheap, systematic exposure to the very factors that active managers use to justify their fees. So where did that leave the traditional active manager? If their old tricks could be replicated by an algorithm, what was their value proposition now? They had to evolve again. The argument shifted from broad market timing and downside protection to something far more specific and concentrated. The new breed of active manager argued their true value wasn't in tilting towards factors, but in doing the things a computer simply can't. It was about qualitative analysis, actually visiting the company, meeting the CEO, understanding the corporate culture, and identifying a competitive advantage that doesn't show up on a balance sheet. It was about making big, concentrated bets. A true active manager, they argued, doesn't timidly buy 200 stocks to look like the index. They have the courage of their convictions to put a huge chunk of their fund into their 30 best ideas. This is something an index fund, by definition, can never do. It's a high-stakes game. If they're right, the returns can be astronomical. If they're wrong, the losses can be just as brutal. And perhaps no one has embodied this new hyper-concentrated, high-conviction style of active management more than Cathie Wood and her firm, ARK Invest. ARK didn't just buy tech stocks. They built entire funds around massive, world-changing ideas like genomic sequencing, robotics, and artificial intelligence. They didn't just analyze earnings reports. They tried to predict the future. For a time, it worked spectacularly. Their flagship fund produced returns that made the S&P 500 look like a savings account. And a new generation of investors was convinced that active management wasn't just alive. It was the only way to invest. But that spectacular rise was followed by an equally spectacular fall, perfectly illustrating the violent, double-edged sword of this new active philosophy. So here we stand today. In a world where the old battle lines are meaningless, the choice is no longer simple. It's a complex spectrum of strategies, from the purest market cap index fund to the most concentrated, high-conviction active portfolio, with 1,000 shades of smart beta in between. The question is no longer just about fees versus performance. It's about philosophy. It's about conviction. It's about how much risk you're willing to take to be different from the market, and how much you're willing to pay for that privilege. The war between active and passive isn't over. It has just become far more personal. And with this new, more complicated battlefield, the ultimate question has shifted from which side is better to a much more important one. How do you choose what's right for you? To answer that, you don't start by looking at fund prospectuses or performance charts. You start by looking in the mirror, because the single most important factor in your investment success isn't the expense ratio or the manager's track record. It's you. It's your temperament, your timeline, your tolerance for risk, and perhaps most importantly, how much time and energy you are genuinely willing to dedicate to this. So let's build your personal framework right here, right now. First, let's talk about your most valuable, non-renewable resource, your time. Be brutally honest with yourself. Are you the kind of person who gets a genuine thrill from reading shareholder letters? Do you find yourself geeking out over macroeconomic trends and competitive moats? Do you have the time and the desire to vet different fund managers, understand their strategies, and monitor their performance? If the answer is a resounding yes, then the world of active management is open to you. It's a world that rewards diligence. But if you hear all that and your brain just screams, "I don't have time for that," that is a perfectly valid and incredibly important piece of self-knowledge. If you're a busy doctor, a small business owner, a parent juggling a million things, your time is better spent elsewhere. For you, the elegance of indexing isn't a compromise. It's a strategic allocation of your own life's energy. It's choosing to be a passive investor so you can be an active participant in the rest of your life. There is no shame in that. In fact, it's one of the smartest financial decisions you can make. Second, let's diagnose your financial psychology. How do you react under pressure? When the market is in a free fall and the headlines are screaming crash, what is your gut instinct? An index fund investor has to be a stoic. They have to have the mental fortitude to watch their entire portfolio drop by 20, 30, even 40% and not panic sell. Their strategy is to buy the whole haystack, and that means when the haystack catches fire, they feel all of the heat. Their only defense is the discipline to hold on, knowing that historically, the market always recovers. On the other hand, an active fund promises a potential defense. The manager might shift to cash or rotate into defensive sectors. But this introduces a different kind of psychological torture, manager risk. What happens when the market is roaring and your active fund is lagging the S&P 500 by 5%? The feeling of missing out, of paying someone to underperform, can be maddening. It can tempt you to jump ship at the worst possible time. So what's worse for you? The terror of a market crash you have to ride all the way down? Or the intense frustration of paying for performance you're not getting? Knowing the answer to that question will tell you a lot about which path you can emotionally sustain for the long haul. Third, what are you actually investing for? Your goals and your timeline are everything. If you are a 25-year-old investing for retirement in 40 years, your goal is simple: maximum growth over a very long period. The single greatest force you have on your side is time, which allows the miracle of compound interest to work its magic. For a goal like that, a low-cost, globally diversified index fund is almost mathematically unbeatable. The corrosive effect of higher active fees over 4 decades can be devastating. A multi-$100,000 difference in your final nest egg. The short-term zigs and zags of the market are just noise. Your strategy is to own the world, keep costs low, and let time do the heavy lifting. But what if you're saving for a down payment on a house in 5 years? Your timeline is shorter and your risk tolerance is lower. You can't afford a 40% drop right before you need the cash. In this scenario, a more tactical, active approach, perhaps in a less volatile asset class like bonds, could make sense. An active bond fund manager, for example, can adjust the fund's duration to navigate changes in interest rates in a way an index fund cannot. The goal dictates the strategy. Long-term, broad goals lean passive. Shorter-term, specific goals can sometimes benefit from an active touch. And finally, what is your core belief about the market itself? This might sound philosophical, but it's the bedrock of your conviction. Do you believe deep down in the efficient market hypothesis? Do you believe that all known information is already baked into stock prices, and that the collective wisdom of millions of investors is smarter than any single genius? If you do, then indexing isn't just a strategy, it's the most logical expression of that belief. Trying to beat the market is a fool's errand, so you might as well join it for the lowest possible cost. But maybe you believe something different. Maybe you believe markets are messy, emotional, and full of irrational behavior. Maybe you believe that buried in the chaos, there are incredible companies trading for less than they're worth, and that there are truly brilliant, skilled people who can find them. If you believe in the power of human insight to uncover value, then active management aligns with your worldview. There is no right or wrong belief here, but choosing a strategy that conflicts with your core belief system is a recipe for disaster. Because when things get tough, and they always do, you won't have the deep-seated conviction to stick with it. So, after all this, you might be thinking the answer is still complicated. And you're right. But what if the debate itself is flawed? What if the question isn't active or passive? What if the real modern answer for most people is active and passive? This brings us to what is perhaps the most practical, elegant solution in all of modern portfolio construction: The core satellite approach. Picture your portfolio as a solar system. At the center, the massive gravitational anchor is your core. This is the sun. This should be the largest part of your portfolio, maybe 70 to 80%. And this core is built on pure, low-cost, broadly diversified index funds. An S&P 500 fund, a total U.S. stock market fund, a total international stock market fund. This is your foundation. It's the engine that will reliably capture the market's return over the long term, guaranteeing that you get your fair share of global economic growth. It's stable, it's cheap, and it's powerful. Then, orbiting around this massive core, you have your satellites. This is the smaller 20 to 30% of your portfolio. This is where you get active. This is where you can express your ideas, take calculated risks, and hunt for that elusive alpha. Your satellite could be an active fund run by a manager whose strategy you've researched and deeply believe in. It could be a sector-specific ETF if you have a strong conviction that, say, biotechnology or artificial intelligence is poised to outperform for the next decade. It could even be a handful of individual stocks you've analyzed yourself. The beauty of the core satellite model is that it gives you the best of both worlds. Your core ensures you're not making a catastrophic mistake. It keeps you on track for your long-term goals, harnessing the proven power of passive investing. Meanwhile, your satellites give you the opportunity to do better. They satisfy that human desire to be clever, to have a say, to try and beat the average. And it's psychologically brilliant. If your satellite picks shoot the moon, fantastic. They provide a turbo boost to your overall returns. If they crash and burn, it's disappointing but not devastating. Your massive stable core protects the bulk of your wealth, ensuring that a few bad bets don't derail your entire financial future. It's a framework that replaces the all-or-nothing choice with a balanced, disciplined, and personalized solution. So, in the end, the great war between active and passive management concludes not with a victor, but with a treaty. A peace accord signed by you. The evidence is clear. For most people, for most of their money, a low-cost passive indexing strategy is the most reliable path to building wealth. The data doesn't lie. But it's also true that we are not robots. We have ideas, we have passions, and sometimes we want to try to do better than average. The journey we've been on, from the first mutual funds to the rise of Vanguard, from the star managers to the rise of the algorithm, has led us here. To a place where you no longer have to choose a side. You can build a system based on your time, your psychology, your goals, and your beliefs. A system with a reliable passive core and opportunistic active satellites. The ultimate goal isn't to beat the market. It's to build a portfolio that you understand, that you believe in, and that you can stick with for the decades it takes to achieve your most important life goals. That is the only victory that truly matters.